So it's Wednesday, January 17th, 2024. And I hope you're all doing really well today. And we're going to look at the bond market today. I think the small party we've had since the end of October or thereabouts could be over for the bond market. And that doesn't bode well for the economy, for the financial markets, and for the consumer, for governments, the cost of credit going up, especially in our fiat currency world. Before we look more deeply into the bond market and what's going on, just wanted to talk a little bit very quickly about private property inflation and taxation. I think those are all three related. I think the West flourished and advanced over the last 250 years because up until maybe 50 years ago, with the exception of wars, and I know those are important, the West pretty much respected private property. We had relatively low inflation. Unfortunately, that's gone out the window. And taxation, especially during the 19th century, was very low. And that's why I think our economies flourished. People became more prosperous. Yes, we advanced. But now it's all going in reverse. And it's with that in mind that I recently partnered with the Dirty Man Safe. And I think some of you might be interested in the Dirty Man Safe, mainly because they're going to come after you. Not physically, or maybe they will, but after your valuables, your possessions, because I think this whole system, of course, is under threat. The system based on private property, low inflation, and low taxation. And yes, if you use my promo code Maneco10, you get 10% off the Dirty Man Safe. So check out their website. They ship to the UK, and I think the whole of Europe now. They definitely ship to the US. They're based in the US. And a lot of the viewers that have bought the Dirty Man Safe are very happy with it. So back to the bond market. And a lot of you know that my background is in the bond market when I work in the financial sector. That was my specialty. And specifically government bond markets, because they are at the base of all the other bond markets. They set the tone for the corporate bond market, for mortgage market, for all other bond markets, because the interest rate that's paid by the government, that's usually the lowest rate in the land, right, so to speak. Doesn't always work that way, but interest rates in the government bond market set the tone for the whole economy. So if interest rates in the government bond market are going down, it means that interest rates in all other sectors of the economy are going down. And of course, the powers that be, i.e. the central banks and the governments, they've been in collusion since '08 and even a bit before to keep these government bond interest rates or yields as low as possible. And why is that? Well, because that keeps the fiat currency debt-based system going. The lower rates are, the lower yields go. The cheaper it is to borrow, to service, and it also, on the other side of the coin, increases the value of these bonds or these assets. And that encourages investors to keep piling on their savings into the bond market. And it allows governments and other bad actors to keep borrowing and spending. But with the advent of real price rises, consumer price rises, with the Cantillon effect really coming from financial assets into everyday basic necessities in the last 2 years, the bond market is reversed, and it's done something very few expected. I warned you, of course, a few years ago that the bull market in bonds that started in 1981 was over. And I'm not bragging here, I'm just telling you what's going on. And so when bond yields started rising in the last 18 months or so, people were surprised. They always thought, oh, it's going to stop at 2 or 3. And it rose all the way to 5%. The US 10-year, for example, we had a bond crisis, gilt crisis in September of 2022 in the UK. Bond yields exploded in a very short period. And it led to central banks having to keep raising rates because they were behind the curve. They were behind the curve when they said that inflation was transitory and that they didn't need to raise rates. And I think they're behind the curve now by saying that they don't need to raise anymore and they're going to keep it pretty much where it is, that they've won the fight against inflation. And by inflation, of course, I mean their measure of prices, which again is another fallacy because that's not inflation. But be as it may, that's the way I'm going to talk today. So what about the party? I said there's a small party. It wasn't a big party. Well, I think it's another false sense of security for these Keynesians, the bull market, the bond bulls. Ever since like the end of October, last year, the U.S. Treasury market reversed, especially in the longer end, the 10-year and the 30-year. And prices started rising. The yield in the 10-year topped just above 5%. Janet Yellen came out, said they're going to issue less long-term bonds. And then you had Bill Ackman, who said, I've closed my short in the bond market. And you kind of wonder where he got a signal from the Treasury and the Fed that they're going to intervene. And yields dropped all the way to below 4%. Recently. So that was the party there, the short party. It wasn't a long party, in my opinion. And things are going to get rough again, in my opinion. And today we had an example of that. We had the UK inflation data. And I say inflation because a lot of you know that inflation is the increase in the amount of currency and credit created out of thin air. It's not based on real savings. But be as it may, the current economic masters that we have, the people on Wall Street in the City of London, the economists, they consider CPI inflation. And that's a big mistake because they think that inflation, it makes them gives them the wrong signals about inflation. And I think we're getting that. So today we had the CPI and RPI, by the way, out from the UK. And the CPI was expected to drop from 3.9 to 3.8. That's it's not really dropping. That's the rate of growth was expected to drop. But it came out at 4%. Even worse. The monthly increase was expected to be 0.2 and it was 0.4. And even the core number, which usually is lower than the headline number because it excludes food and energy, that one came out at 5.1 and it was expected at 4.9. And the month on month in the core was 0.6. So they have no control of prices yet. And what about the RPI? Well, the RPI is an old measure of prices that they used to use up until the late 90s. And it reflects more the basket of goods for an average family. So I think it's even more important, the RPI, even though they ignore it now. But that's at 5.2, was expected to come out at 5.1. And what's happening today is that UK gilt yields Gilts are the name for the UK government bonds. They're spiking higher. For example, the 2-year, which is an important one to keep an eye on because a lot of mortgages are based on the back of the 2-year. That's up 14 basis points at 4.3. And yes, it's way below where it got to. Let's see here. In July of last year, we got up to above 5.5%. And as you can see by this chart, it has been coming off. This is a weekly chart. But I think the bottom might be in here for this, this chart of the bond yield. So the higher yields go, the worse it is. It means that mortgage rates are going to go back up. So we have had a respite in the housing market, mainly because of this a move in the 2-year yield. And I think we're going to go higher. So we need to keep an eye on this. Of course, I could be wrong, but this is the my view. My view is that now we're in a bear market for bonds. And that means that instead of buying the dip in terms of the price of bonds, you sell the rallies. And it is a bit confusing. Bond yields are inversely related to the price, and it's very simple. So if the government sells a bond at 100, let's say a price of £100, and it gives you a coupon of 5%, if in the secondary market that bond starts dropping in price, let's say to 95, you're going to still be earning the 5%. But if you divide that 5% into the new lower price, you get a higher yield. And that's why prices and yields are inversely related. So it is a bit confusing, but it's if you look at the maths, it's not. And yeah, so I think the next few months could be rough. We could see those rates start going up. And as you can see here, during the crisis in 2022, that 2-year yield spiked to just below 5%. And then last year we went above that rate. And I think this time around we're going to go above the rate from last year, the yield from last year. And that's going to set the cats amongst the pigeons. And this is going to affect the whole financial system, the economy. As I said earlier, consumers, a lot of consumers, unfortunately, are still leveraged, i.e., they've had to borrow a lot of money through credit cards or through, when they remortgage, when they lease or buy a car on finance. And yes, it's going to affect everything, and the government itself. The government is going to have to roll over old debt and pay more, and that's going to increase their deficit. That means they won't be able to cut taxes. They might have to increase taxes or increase borrowing. And I could see the central banks, they're going to have to hold. They're not going to be able to cut rates as people have been wishing that they were going to do. And they might even have to raise rates. It's a mess. So how does gold and silver play into this? Well, some people might think it's negative for gold and silver. I don't think so, because people are going to wake up and realize that central banks don't know what they're doing and they're behind the curve and that they're incompetent. And when there's monetary incompetence, gold and silver should do well, in my opinion. So, yes, let's keep an eye on the bond market. I think the short party is over. And with that, let's quickly look at where the markets are this morning. It's 8:39 a.m. London time. So spot gold is down about $4, trading around 2024. High's been 33, the low has been 17. Silver is down 17 cents, trading at 22.74. High's been 22.98, the low 62. the stock markets have been all over the place. They seem to be on the back foot a little bit. Looking at the S&P chart, it looks like we might have formed a double top, as you can see here. But anyway, right now the Dow is down 100 points at 37,250. It has been down as much as 150 points. The Nasdaq is down 115 points, 2/3%. S&P is down 21 points or 0.5%. To the currencies, ironically, it always seems to happen this way. The pound is actually up a little bit, like a 0.2%. And that's because the markets with CPI data think that maybe the Bank of England won't be able to cut as much, might have to raise, and that's why the pound's stronger. You'd think with the fact that they're not really fighting CPI or inflation that well, that the pound would be weaker, and I think in the long term it will. So it's at 126.58. The euro is unchanged, 108.74. The dollar's still quite strong. It's rebounding, has been rebounding, especially versus the yen. It's up 0.4 at 147.80. Versus the Swiss franc, dollar's unchanged, 86.21. But yeah, yesterday was the dollar rallied quite strongly. There was a Fed governor, I think, Waller. He said the markets are maybe getting ahead of themselves in terms of thinking how many times the Fed's going to cut, even though he said the Fed would start cutting this year. We'll have to see, of course. Versus the yuan, we're at 722, so dollars rallied there as well. Recently, we're down around 714 versus the yuan. To the other currencies, Aussie dollar, that's down 0.5%, 65.50. The dollar is up slightly versus the Canadian dollar, 135.15. And the Kiwi dollar, that's down 1/3%, 61.17. Let's check out the commodities market. WTI crude is down 1.5%, 71.30. Brent crude is down 1.5 as well at 76.88. We've got platinum, that's down $7, trading around 893. And high grade copper is down 1% as well at 374. Just have a quick look again here at the UK gilt market. Yes, the 2 years up 16 basis points now. The 10 years up 13. And the 30 years up 13 as well. We're fast approaching 460. Yes, and I've said it before. I've done videos about it. Back in May of 2022, the government revised the way they calculate CPI, and it's probably about almost 1% lower than it should be. That's just to hide, their inflationary policy. So leaving your savings in cash, even if you're getting 4 or 5%, I think you're losing in real terms. Gold, of course, has averaged almost 10% every year on average per annum since the year 2000. Last year, I think it was against the pound, it was up about 8%. So gold's still protecting you. Silver not so much, but silver is a bit more speculative, and it will protect you in spades once it catches up to gold and flies past gold, in my opinion. So there you go. With that, I'm going to wish you all a very good day. Take care. Bye.